Our Chapter 12 lecture covers a financial statement known as the Statement of Cash Flows. We're going to talk about the usefulness and format of the Statement of Cash Flow, prepare a Statement of Cash Flow using what we call the indirect method, use a Statement of Cash Flow to evaluate a company. So you ready? Let's go. So the Statement of Cash Flows. This is a financial statement that shows the change in cash from the beginning of the accounting period until the end of the accounting period. We can use the Statement of Cash Flow to estimate future cash flow, to show our ability to pay out dividends and meet other financial obligations, show the difference between what we call the net income from the accrual accounting system to the net cash provided by operating activities, show the cash that we use or receive from investing and from financing transactions. So this statement of cash flow is all about the change in the cash account from the beginning of the accounting period until the end of the accounting period. So we focus on the different type of activities that cause the change in the cash account. We'll first look at what's known as the operating activities. When you think about operating activities, think about your normal daily type of business transactions, from providing services, selling products, buying supplies, paying your employees, acquiring inventory. We're looking at those normal everyday type of business transaction. So we'll look at the revenue amount shown on the income statement as well as the different type of expenses. When you think about your investing activities, think more about your long-term assets, your property, plant, and equipment assets, and if applicable, any type of long-term investments, as well as your intangible assets. So we'll focus on the changes in our long-term assets, whether we acquired additional long-term assets or if we sold long-term assets. Then when it comes to your financing activity, think back to Chapter 10, where we covered debt financing, which are liabilities. And then in Chapter 11, we covered equity financing. So the financing activity shows the change in cash that came from our debt or equity financing activity. When you combine these transactions all together, it will indicate to us whether our cash account increased or if the cash account decreased and by how much. All right, so let's begin looking at different types of operating activities. We'll look at first the cash inflows from operating activities. So you think about the sales of goods or services, that's going to be a cash inflow from your operating activity. Or any interest that we may have earned, or if we receive dividends, again, those are an inflow of cash coming from our operating activity. When you think about your cash outflows, think about buying supplies for inventory, paying out wages, paying taxes, interest for loans, other operating expenses, or examples of outflows under your operating activity. So the income statement shows the revenue, cash inflows. It shows all the expenses, the cash outflows. When you think about your investing activity, again, you're focused on any changes in investments and your long-term asset. So cash inflows will come from the sale of property, plant, or equipment assets, from sale of investments in type of long-term investments. So we sold stocks and bonds that we own of other companies. Those qualify as being long-term investment. collection of principal of loans to other entities. So if we loan money to another corporation, that can be done what we call commercial paper or receivable. We look at the money coming back in to us as a cash inflow up under the investing activity section. When you think about your cash outflow from investment, the purchase of any property, plant, or equipment assets, the purchase of investments, whether we're talking about purchasing stock or purchasing bonds of other companies, or when we make loans to other entities, these all qualify as being cash outflows up under your investing activity section of the statement of cash flow. And then last, we have the financing activity. When you think about your financing activities, focus on the liability and the stockholders' equity section of the balance sheet. When you think about your cash inflows, cash coming from the actual sale of common stock or from issuance of debt. So if we issue bonds or a notes payable, that's going to be cash coming in from our investing or our equity or financing activity. When you're paying out dividends to the stockholders, that would be a cash outflow up under your financing activity. When we redeem long-term debt, meaning if we're paying back bonds, notes payable, or if we buy back our own stock, known as treasury stock, these all qualify as being cash outflows up under the financing activity section of the statement of cash flow. Then we have what's known as significant non-cash activities. Significant non-cash activities. These are significant business transactions that do not impact cash directly at this point in time. However, they will have an impact on cash at some point in time in the future. For example, direct issuance of common stock to purchase assets. So a company exchange stock in exchange, say, for a building, that's a significant non-cash activity. We're going to disclose this information at the bottom section of our statement of cash flow. Remember back in chapter 10, we talked about convertible bonds. When those bonds are converted into common stock, again, that's a significant non-cash activity that would be shown on the statement of cash flow. So when you have these type of transactions, it means that they do not impact cash immediately, but they will have an impact on the cash account in the future. We're going to disclose this information on the bottom half of the statement of cash flow. Okay? Now, there are two methods used to prepare the statement of cash flow. One is known as the direct method. The other is called the indirect method. Under both approaches, you still have these three sections: operating activities, investing and financing activity. The order of presentation is the same on either approach preparing a statement of cash flow. Now, what you will see that with the direct method, which we'll look at a little bit later, it means we're going to identify every cash source, show all our cash inflows, and show all of our cash outflows. With the indirect method, we're going to begin with what we call an accrual-based net income, convert that over to what's known as a cash-based net income. Now, under either approach, the direct or the indirect, the investing and finance activity section stays the same. It is the operating activity section that's going to be different depending upon whether you use the direct method or the indirect method. Now, they will both give us the same end result, but we'll see how they'll take two different approaches to determine whether we had net cash inflows or net cash outflows from our operating activity. 90% of all companies use the indirect method, so that's going to be our main focus is on how to prepare the statement of cash flow using what's called the indirect approach. All right, so let's get right to it, shall we? And we shall. So here you see a sample of the statement of cash flow just from a outline of it. You're going to indicate the name of the company, the type of statement, and the time period being covered. We're going to show all of our cash inflows and outflows from our operating activities, same for your investing activities and for your financing activity. We'll then determine overall, did we have an increase in our cash account or did we have a decrease in our cash account? We'll look at the beginning cash balance. You either add in the increase to the beginning cash balance or subtract out the decrease from the beginning cash balance to determine the amount of cash at the end of the period. Then in the last section, we're going to list any non-cash investing and financing activity will be listed in the latter portion of the statement of cash flow. Okay? So here we have a few different type of activities. The question is, for 1 through 5, can you identify each as either being an operating activity, a investing activity, or a financing activity? So you ready? Let's go. Number 1 says, we issued 100,000 shares of $5 par value common stock for $800,000 cash. Would this qualify as an operating activity, an investing activity, or as a financing activity? If you said financing, you would be correct. Next, borrow from Castle Bank $200,000, signing a 5-year note bearing 8% interest. Once again, this would be an operating activity, an investing activity, or a financing activity. And again, if you said financing activity, you would be correct. Next, purchase 2 semi-trailer trucks for $170,000 and paid cash. Operating, investing, or financing? Investing would be correct. 4, paid employees $12,000 for salaries and wages. If you said operating, you would be correct. And the last one, collected $20,000 cash for a service performed. And again, if you said operating, you would be correct. So it's important that you can identify the different type of cash flow activities as being operating activities, financing activities, or investing activities. When it's time to prepare the statement of cash flow, we'll first look at a comparative balance sheet, a current income statement, as well as additional information in order to prepare the statement of cash flow. So, go get some paper and pencil. We're now going to begin preparing the statement of cash flow using the indirect method. So you ready? You excited? Okay. So stay tuned for part 2 of our Chapter 12 lecture.